Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we want to talk about an interesting topic: are millennials driving the stock market higher?
Well, Peter, we can't prove that they are, but I think there's a lot of evidence to say that certainly millennials and other newer investors are really behind one of the reasons why the rally has gone on. Let's look at some of the data to support the argument. First of all, we know that from the major retail brokers, their trading volumes have absolutely soared. We also know that they're getting a lot of new account applications. That's first-time investors opening trading accounts and others. Thirdly, that some surveys have been done that show that millennials are potentially a lot more interested on the share market and focused on the share market than they are the property market. Yep. Maybe because property market's hard to afford, but
and it's a way they can build up their deposit. They won't do it during using term deposits.
Yep. Fourthly, that we look at the stocks that are actually being traded. We can see that there's a lot of interest in tech, travel and consumer discretionary. Let's show you a couple of graphs or some data to just prove that point. This is the most traded stocks on nabtrade for the week ending the 19th of June. Now, they're always got to be the top 10 stocks up there because they're the biggest, most active stocks. But have a look at these names. Fortescue at number one, which really blew me away. But look at the payments companies, the Split Payments, Zipco and Afterpay. And I guess a lot of millennials are using those companies.
They understand those businesses.
Also Flight Centre, I said, because of, I guess, some of the volatility. Compare it back to the last week of April and you'll see what I mean by what it used to be like. These are all top 10 companies with the exception of Afterpay, a much more traditional set of companies. So,
and probably driven by older and more traditional investors.
If we just move on to the last couple of points, Peter, look, we know that retail clients have been net buyers and that data comes from all the major retail brokers. And finally, some of the so-called institutional fund managers, the big boys around town, have been complaining about retail.
They've got competition for the companies they usually buy.
Yeah, so that always tells you something. So I think they've been a big factor in why the rally's gone on. But look, we've seen a lot of reports about it being a bigger case in the USA, and I don't think it's quite the case it is in the States. Let me just show a couple of things to put the US market in comparison with the Aussie market. This shows you the performance year to date of the ASX 200, that's the blue line, the US S&P 500, that's the purple line, and the NASDAQ composite, that's the green line in 2020. We can see the ASX 200 is still down a bit more than 10%. The S&P 500 is getting close to line ball year to date, but the NASDAQ, Peter, which is pretty tech heavy, that's up over 10%.
Yeah, and I suspect a lot of younger investors getting in the market for the first time would have been chasing the FANG stocks, which drives the NASDAQ composite for sure.
Now, this is not the first bull market, Peter, and I guess wiser heads have been around a bit. What are some of the lessons that history teaches about the performance of other markets?
Yeah, well, I think it gets down to this, Paul, that you always buy quality companies. One time, good companies can fail when economies crash. Don't be afraid to take profits on fast rising shares. Some investors sell gains to take their initial stake out, then they let their profits run. Be wary about using borrowed money to buy shares. It's great for magnifying the gains, but it also magnifies the losses. Buy quality companies at historically low prices to hold for a few years should be generally a rewarding strategy. I also say diversify. Don't be reliant on one company that could be badly affected by a government decision, a silly CEO or a pandemic.
And we do see silly CEOs, Peter. They do acquisitions that don't have a lot of sense or do some other things. It is a risk. It's one of those things you can't, even a great company, sometimes the CEO makes a bad call, he or she, and the shareholders end up suffering.
Yeah, and a government decision could affect a company like Afterpay. So you always got to remember that sort of thing. And finally,
and you can't control those, right? You can't control the regulatory risk that suddenly comes from left field.
And that's why having more than one company in your portfolio makes a lot of sense. Finally, understand you are taking risks to gain higher returns, so you can't complain if you cop some losses along the way. So that's Switzer Investing Insights, brought to you by nabtrade. Thanks for joining us.